Welcome to vTalkInsight, Market Drivers Daily for March 27th, 2026. Middle East tensions have choked one of the world's key oil arteries, keeping crude in triple digits and forcing a rethink of both inflation and interest rate paths. Let's look at how this geopolitical shock is rippling through energy, bond yields, and the inflation outlook today. Geopolitical risk in the Middle East, and especially the squeeze on the Strait of Hormuz, has become the dominant driver for global assets today. Markets are weighing a working assumption of partial de-escalation against increasingly severe tail risks around energy supply and growth. Physical disruption is stark. Vessel traffic through Hormuz has collapsed from well over 100 ships a day to only a handful of tankers, and reports of Iranian forces turning back container vessels underline that this is not just an oil story, but a broader trade shock. Persistent constraints on crude and refined products are keeping Brent just above $110 a barrel, with this month shaping up as one of the strongest oil rallies on record. The military and diplomatic backdrop remains fragile. Iran continues to launch missiles and drones at Israel and Gulf states, and retains the ability to scale up pressure through regional proxies such as the Houthis, keeping shipping lanes at risk. Washington is considering additional troop deployments, with figures as high as 17,000 discussed, while separate reports point to 10,000 more personnel under review. Yet, G7 and NATO countries show little appetite for direct combat operations, focusing instead on coalition patrols to keep sea lanes partially open. On the diplomatic side, deadlines for U.S. Iran talks have been extended several times, but there is still no sign of direct negotiations, and mediating efforts by countries like Pakistan, Egypt, and Turkey have yet to produce a breakthrough. This mix of constrained supply and stalled diplomacy is embedding a higher oil price regime across markets. Brent is holding near $110 to $111, with analysts openly discussing scenarios where prices push toward $150 and, in a prolonged disruption, even test $200 a barrel. Such paths imply record inventory drawdowns, with estimates of as much as 600 million barrels disappearing from storage within 2 months if flows do not normalize. Equity markets are already feeling the strain, with global indices chalking up their weakest month in around 3 years and S&P futures lower after the sharpest daily drop since this conflict began. Flows show investors cutting equity and duration risk and moving closer to benchmarks, while defensive sectors such as energy and staples outperform and rate-sensitive names, travel, and small caps lag. Cross-asset signals point to broad risk aversion rather than clean safe haven demand. Global bonds are selling off alongside equities as yields rise, so traditional hedges are not absorbing the shock as they did in past crises. The U.S. dollar has emerged as the main refuge, appreciating more than 2% since the war started, while gold has seen mixed price action and even large outflows from commodity funds despite its recent bounce with oil. European equities highlight this caution. The Stoxx 600 briefly opened firmer but quickly slipped into losses as higher oil and renewed U.S. China trade frictions weighed on risk appetite, and regional trading volumes are running more than 30% below recent norms as many participants simply stay on the sidelines. Scenario work remains highly two-sided. The base view in many markets still assumes some de-escalation and a partial reopening of Hormuz within about 4 weeks, with futures curves in backwardation signaling expectations that today's extreme tightness will gradually ease. But the downside scenarios are severe. Analysts warn that a move toward $200 oil could push global growth toward recession, drive equity drawdowns on the order of 30%, and create something akin to a pandemic-style macro hit if shipping routes remain compromised. In contrast, a reopening of oil flows, even with ongoing hostilities, could see Brent fall back toward $80, relieving headline inflation and potentially unlocking a more supportive central bank stance. The key watch points now are tanker throughput in Hormuz, signs of damage or repair at Gulf energy infrastructure, any firm commitments from a G7-led maritime coalition, and whether China uses its economic leverage over Iran to press for restraint. With geopolitics setting the backdrop, the next question is how rate markets are digesting this energy shock. Against that geopolitical backdrop, the rates complex is struggling to decide whether it is facing an inflation shock that demands more tightening or a growth shock that argues for patience. For now, market pricing has shifted in a more hawkish direction, even as central banks signal caution. In the United States, futures now assign roughly even odds to another rate increase by October, and in Europe markets see about a 3 in 4 chance that the European Central Bank delivers at least one more hike by year-end. U.S. Treasury yields have pushed to new highs for the year, with the 10-year around 4.45% and the 2-year near 4%, and curves have flattened as shorter maturities reprice more sharply. This repricing is taking place in an environment of strained bond demand. Long-duration bond funds have just recorded their second-largest weekly outflow on record, pointing to deep unease with interest rate risk. Recent U.S. Treasury auctions in the 2, 5, and 7-year sectors have been lackluster, and measures of market depth suggest thinner liquidity, increasing the risk that volatility spikes could become disorderly. There is a non-trivial scenario where the Federal Reserve is forced to stabilize the Treasury market with liquidity tools, even while it is ostensibly in a balance sheet runoff phase, which would complicate the narrative of a straightforward tightening cycle. Policymakers are trying to distinguish between what they see in models and what markets are pricing. Internal Fed work suggests that pure oil shocks, on their own, are not a compelling reason to hike, especially when monetary policy has limited power over supply-side disruptions. Officials are emphasizing 3 conditions before any fresh tightening: evidence that higher energy prices are leaking into broader inflation, signs of second-round wage effects in still resilient labor data, and proof that inflation expectations are becoming unanchored. The ECB has made a similar distinction between raising rates simply to catch up with higher underlying inflation and actively pushing policy into restrictive territory, and several European central bankers are signaling a readiness to wait for clearer evidence before committing to more hikes. As a result, there is a growing gap between markets and central banks. Some analysts argue that investors may be overestimating the odds of near-term Fed tightening, given officials' stated preference for stability, while the outlook is clouded by geopolitics. At the same time, higher yields are already tightening financial conditions. Mortgage rates are at their highest levels of the year, credit spreads have widened, the dollar is strong, and equities are under pressure. That in itself may reduce the need for additional policy moves. The key indicators to monitor now are upcoming labor market and inflation prints, auction results, and bid cover ratios, any signs of dysfunction in the Treasury market, and fresh guidance from the Fed, ECB, and Bank of Japan on how they balance inflation risks against growth and financial stability. All of this feeds directly into the question of whether today's price pressures turn into a renewed inflation cycle. The third piece of today's story is inflation. Energy and food shocks are now raising the risk that price pressures reaccelerate rather than glide gently back to target. With Brent holding around $110 and scenarios on the table that see prices staying in the $110 to $125 range, the probability of second-round effects is increasing. Analysts warn that if crude were to surge toward $200 in a prolonged disruption, U.S. gasoline prices could reach around $8 a gallon, and headline inflation could move into the mid-5 to 6% zone, at least temporarily, before easing if supply normalizes. The pass-through channels are already visible. Rising gasoline prices are estimated to be draining roughly $12 billion a month from U.S. consumers, shaving about 1 percentage point off real spending growth and weighing on GDP forecasts. Airlines are considering fare increases of up to 20% to offset higher jet fuel costs, while sectors such as autos and semiconductors face additional strain from shortages of inputs like aluminum alloys and industrial gases. On the food side, disruptions to fertilizer and key agricultural inputs, with around 1/5 of some ingredients imported and orders already disrupted, point to further price pressure that will hit different regions as planting and harvest cycles roll through. Inflation expectations are starting to reflect this backdrop. The latest University of Michigan survey shows one-year household inflation expectations jumping to around 3.8%, while market-based measures suggest that average inflation over the next decade has moved from just above 2 to over 3%. These shifts have helped push long-term yields higher and supported a strong dollar, which in turn complicates the picture for emerging markets that rely heavily on imported energy. Economies such as Egypt and Turkey, already dealing with currency weakness, face particularly acute inflation risks, and smaller Asian importers with limited reserves, like the Philippines and Thailand, look vulnerable on both the FX and credit sides. This combination of higher inflation and slower growth raises the specter of stagflation. Traditional 60/40 portfolios are having their weakest month since 2022 as both equities and duration struggle, and the estimated probability of a U.S. recession has nudged up from about 25 to 30%. Second-round inflation risks would rise further if governments respond with large-scale fiscal support, as seen in the demand-driven surge of early 2021, rather than targeted measures. There are, however, buffers. The global economy is less energy-intensive than in past oil shocks. The U.S. now has the profile of an energy superpower, and recent productivity gains are helping to offset some input cost pressure. Models suggest that a U.S. recession is unlikely unless crude moves well above $120 for a sustained period. In a scenario where Hormuz reopens and Brent falls back toward 80 would quickly ease headline inflation and reopen the door to rate cuts later in the cycle. The balance between these paths will be shaped by incoming data and how long today's energy shock persists. To sum up, today's market narrative is anchored by a geopolitical shock that is keeping oil in triple digits, pushing bond yields higher, and reviving inflation risks across energy, food, and transport. Rates markets are leaning toward a more hawkish path, while central banks still signal patience, and traditional diversification between stocks and bonds is under strain. The key variables from here are the physical status of the Strait of Hormuz, how fast inflation expectations evolve, and whether bond markets can absorb higher yields without tipping into dysfunction. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.